Okay, thank you so much for sticking around for this next conversation. I'm Dan Murphy from CNBC. Thrilled to be here with a very expert panel joining me for an investment outlook into 2025. So thank you for being here in the room, and thank you as well for joining us online. Ladies and gentlemen, joining me on stage is Muyiwa Akinyemi, the Deputy Group CEO, United Bank of Africa Group. Muyiwa, welcome. David Hunt is President and CEO of PGIM. Katie Koch is the President and CEO of TCW. Sébastien Page is the Global Head of Multi-Asset and CIO at T. Rowe Price. And John Studzinski is the Managing Director and Vice Chairman of PIMCO. So let's dive straight into the conversation. And thank you again for being here. First of all, Muyiwa, to you. When you look at the global outlook, what are you focusing on in 2025, and how can global investors and managers effectively manage the market volatility that is to come?
Thank you so much for that question. And I think for us, United Bank for Africa, 7 decades in existence right now, our focus remains clearly Africa. So for next year, we're looking to see how to scale up our investments or our partnerships in the infrastructure space, particularly, and the SME space as well. And we've done this for years, and we've seen how we've been able to balance the risks across Africa. Africa is what we know, Africa is what we do. And 2025 is going to be an interesting year for us as we look at a lot more stability in the sector, we look at a lot more risk moderation, should I put it, and less volatility across Africa.
Thank you very much.
Welcome.
David, over to you. Of course, PGIM, one of the largest asset managers globally. So what's your view on the outlook for 2025, and what assets, what markets are going to deliver the best return?
Well, first of all, it's a pleasure to be with everybody today. And as you really point out, PGIM is one of the largest asset managers in the world. We have about $1.4 trillion. We manage money across both public and private asset classes, and we manage money in about 30 countries around the world. I would say that the biggest change in the last 12 months has actually been a geographic rotation rather than an asset class one. So if you spend time in Europe, Europe is no bigger than it was in 2018.
Sure.
And growth is absolutely very, very hard to find. And so there is no capital at this point that's going into Europe. On the other hand, you spend time in Asia. You spend time in Japan, where there's a new bounce in their step for sure. You spend time in ASEAN, where you see the whole reconfiguration of supply chains really taking shape. So Vietnam, Indonesia are all of a sudden seeing real inflows into it. China, really no new inflows going in at all. People are still on the sidelines. And that brings you back to the United States. And you know, for all of the difficulties in the United States, which I'm sure we will come to, the US economy remains resilient and strong, and maybe most importantly, innovative. And more money is going in to the US, which, as I talk to CEOs, their main point is, I feel really nervous about that, but there is no better place for our money right now than in the United States. So that is a huge capital shift than if I had told that story 4 years ago. And I think it's not to be underestimated as we look into 25.
Just on that point, you mentioned you're pretty optimistic on the outlook for the US. We'll touch on the election in a moment.
I'm sure we will.
If you were to boil it down into kind of one sentence, bullish or bearish 2025, and why?
So first of all, I would never accept a one-year time horizon. We're long-term investors, and we actually believe that money we will put out now will actually be a very good vintage. And the reason that we are bullish on the US is because of its relentless innovation. And people have tried to bet against the US for a long time, and it never actually ends up well. For all of the difficulties and problems, productivity has remained markedly higher than other economies around the world, and we actually expect that to continue. Capital investment into really knowledge-based industries is growing very rapidly, even as capital for infrastructure and others has been slowing. The capital into software is rocketing.
Very interesting. Okay, Katie, welcome into the conversation. We're so happy you're here.
Yeah.
I wanted to ask you about bond yields as well, because we've been talking about this. We've been looking at the rise in the 2 and 10 yields, perhaps starting to look attractive again. And I'm wondering, what's your take on this? Is this the start of a long-term bull market in fixed income, or just a reprieve for when inflation comes roaring back?
I hope it's the start of a long-term bull market because I just moved to a mostly fixed income, lead a mostly fixed income company. So it would be really good for my career
That's the right answer. That's the right answer.
So just the 15 seconds, because I think it's helpful just for people to know your perspective. I have the privilege of leading TCW, global asset manager. We manage about $200 billion for clients all over the world. This is a very important region for us, and we've managed capital in this region for 40 years. And so it's really a privilege and a pleasure always to be in the region, but especially in Saudi Arabia. So thank you so much for having me, and to our hosts with FII. To answer the question on bull markets, this is what I would say. Medium term, we are positive on fixed income markets. We're probably a little bit more cautious than others on the near-term economic outlook, and I can unpack that in more detail later if people are interested. But I would say our number one focus and area of concern, and I'll just talk about the US because you asked about that, is that if you look at risk assets in the US, and for us the lens is largely private credit, and public equities, there's a lot of complacency. As investors, we have to live in a world of probabilities. And right now, we are pricing in 100% probability of everything going right. And I agree with I'm very optimistic on long-term trajectory of the US, but from a valuation perspective, right here, right now, credit is at a 20-year tight. Actually, the OAS adjusted spread for investment grade credit right now from these levels has 100% of the time historically delivered negative returns. And equity markets are at some of their most expensive valuations in history. And private credit, we think there's some cracks as well, which I can unpack if people are interested. So our main issue is that valuations are extremely demanding. They're priced for perfection, and we think something else might happen. And so I'll end by saying the way that we're positioned across our portfolios, a little bit conservative. We have a lot of liquidity. We like agency MBS, which is trading now at a premium spread to investment grade credit, and we're going to wait. You said that never be negative on the US. That's a Warren Buffett favorite. His partner, Charlie Munger, used to always say, the money's not in the buying and the selling, but in the waiting. So that is what we are doing, and we think we're going to get a lot of opportunities in the near term here for volatility, and we're going to step in and be a liquidity provider in those moments when other people can't or won't. And that's been a great way for us to create wealth at TCW.
Really.
But yes, we want a bull market. Everyone root for that for my career.
Sébastien, come on in here, because I think you can also challenge that perspective and also talk to me about the stock-bond correlation right now, and again, bullish, bearish on 2025 and why.
So thank you for asking about the stock-bond correlation, because I've done a lot of research on this, but no one ever asks. And thank you for asking. This morning on CNBC, I got to talk about the stock-bond correlation for the first time in my career on TV. It is the most underrated input to portfolio construction. You need to have an assumption about the stock-bond correlation. Going back 80 years, on a 12-month basis, it has flipped sign 29 times. It has ranged from minus 80% to plus 80%.
Wow.
And we've gone through regimes where the stock-bond correlation was mainly positive, and regimes when it was mainly negative. So to all advisors in the world doing portfolio construction using the average stock-bond correlation, you're kind of like the famous story of the statistician who had their head in the freezer and their feet in the oven and claimed that on average they felt fantastic. That is the assumption you're making. Looking forward 12 months, I think that because of increased inflation volatility and rates uncertainty, we're more likely than not to see a positive stock-bond correlation, and therefore we should adjust our risk levels in our portfolios, taking that into account. I want to challenge the bear narrative for a second. Yes, markets are expensive. I don't think the US economy is slowing. Atlanta Fed GDP now is at 3.3%. We started the year at 1.9%. Services PMIs are at 55. We were at 49 a few months ago. The Fed is injecting liquidity in the system. We're spending on fiscal. The economy is not slowing in the US.
Yeah, I don't. We're not super bearish, but we are a little bit overweight duration at the front.
Your point was valuation. Yeah,
Sorry?
your point was valuation.
Yeah, economically, like, it actually, either if we even have a soft landing, we would still say valuations are.
Yeah, that's the problem is the consensus. I just want to add one more thing. PGIM 1.4 trillion, not that I'm competitive, T. Rowe Price 1.6 trillion.
Well, perfect time to bring in PIMCO, which I believe is plus 2 trillion.
Ooh.
Hello. Yeah.
What an introduction. Thank you very much.
So
Before you ask the question, could I just go
go
over
on.
to the question of the U.S. economy? Because you talked about productivity. And one of the things we're really fascinated by, we've done a lot of work on, is the impact of talent migration and population growth in the United States. Approximately 2 million jobs per year in the last several years. And that how you can correlate that, Mr. Correlation on my right here, directly with positive GDP growth. And it really does argue, I think in terms of public policy, the need to look at strategic talent immigration and making sure that the economy continues to grow. It's easy to ignore that, thinking that it's a political issue, but actually it's fundamentally an economic issue. And it's really important in terms of productivity. So I'm sorry to cut you off, but I wanted to make that point because people overlook the point about productivity. They talk a lot about the coming productivity with AI, which I think is we're just starting to see signs of. But what's really interesting is talent migration and how that affects the GDP.
absolutely fair point. I'm glad you brought it up. We can unpack it further if you like, but as an extension to that, what is the PIMCO worldview coming into 2025, and what do you believe are the risk assets that are going to outperform?
Well, it's a whether you say it's a tale of two cities or a tale of two worlds, with the barbell of the United States, which I think we see continues to perform well, and it is really the destination right now for most investment capital as you look around the world. You've commented on Europe well, and there's not many conversations even going on here about Europe. And you go to Asia and China, and there's no question we're having this ongoing conversation about China slowing down. I think you actually have to look at China, and the Chinese economy is contracting, and it is contracting. If you look at VAT, value-added tax data, from the last 12 months or 18 months, the Chinese economy is contracting. There's another meeting coming up November 4th through 6th, where they're going to talk about stimulation, fiscal stimulation. But to a certain extent, the deflation in the Chinese economy hasn't really had an impact on the United States at all, because the two economies in the short term have really decoupled. And you don't really have too much impact the way you do. The relationship between Europe and China, particularly the German economy, which is at an all-time low, and China are much more heavily correlated in the current environment. So the US, the last couple of years, we looked at GDP growth between 2.5% and 3%. We're looking at GDP growth this year slowing down a bit, but closer to 2%, depending on how you want to calculate it.
Anyone else want to weigh in on the China angle here? Because there's a big question about the investability of China in this environment. The stimulus measures that we've seen from policymakers haven't necessarily landed from an equity market response perspective. So what more would each of you like to see from Chinese policymakers in order to improve the investability of that country? John, you want to go first?
I'll be very brief on this. We're underweight in Asia, and we're very much underweight in China. But I think it goes to a governance point. One of the current issues in China has to do, and everybody here who's a fiduciary, you're very focused on the fact that it's about transparency, disclosure, discipline, and governance. And I think right now we have a period in the Chinese economy among a number of industries where there isn't a lot of proper disclosure and transparency. And I think until that gets rectified, you're going to have investors being very wary.
David,
Well, I think that China is just maybe an example of a larger point, which is that as I talk to CIOs around the world, they want to talk about geopolitical risk. That is the number one thing. They're actually not that interested in interest rates or a variety of other things. They want to say, look, if I look at my portfolio, the global pandemic and 2 wars that nobody expected are what's really had me concerned. It wasn't the correlation, with all due respect to the excellent work, and that it wasn't actually the traditional business cycle. They want to talk about, what happens to an expansion of the war in the Middle East? What's that going to do? What if we do have much more than just de-risking with China? What happens then? And so in the work that we've been doing with clients has been a lot of much more bespoke scenario work about how do you make a portfolio more resilient to geopolitical risk. In some ways, this goes to Katie's point. The single answer to that question is actually liquidity. Because if you can't move when the markets move quickly, then you're not going to be able to take advantage of it. I mean, some of the best money that we put out was in 9 and 10. It was absolutely in 21 and 22. And so if you have delightfully invested all of your money in private equity and you have no capital left, then if we have one of these big market moves, you're not going to take advantage of it. And so I do think that we say tongue-in-cheek, should every large plan have a chief liquidity officer? But there's a lot of truth to that your view on liquidity and your view on diversification is very different if you say, my main risk at this point is great uncertainties and tail risks in the geopolitical atmosphere.
I just want to emphasize and elevate that point. I 100% agree with that when we meet with asset owners, and because people have these large commitments to alternatives and they're not distributing back for the reasons that we all know, people are quite short liquidity in their portfolio. And then actually, just in general, the market's short liquidity because the banks can't step in the way they used to. So when we talked about that dislocation before, that chance to be a liquidity provider, I would argue all those inflection points you said, this opportunity is going to be bigger whenever it comes because there is less people going to be competing for those dislocations, less capital.
Muyiwa, jump in here as well. You want to respond to that?
Yeah, I just want to talk about the talent migration you mentioned earlier. And I'm saying to myself, China is an aging population right now. Europe is not expanding. And each time we look at the geopolitical situation, we see Africa growing. The average age in Africa is about less than 19 now. By 2030, you're going to have 2 billion people. Over 70% of them will be young and youthful people. And that's the population that you need to invest in for the long term, 20 years from now. And that's the population that's coming out with new ideas, innovation, tech. I mean, just yesterday, some investment came in for one of the unicorns in Nigeria. We have them. We talked about the Silicon Savannah in Kenya as well. So there's a lot of opportunities in Africa that I think I know he knows it, but some of us need to also look at unpacking Africa to actually look at the latent opportunities. In the next 5 years, next 20 years, that's where the growth is going to be.
We agree. We own the African bonds.
Yeah.
And it might be uncorrelated growth.
True. But you see, you need to know how to navigate, because most people look at Africa and say it's just one country. There are 54 nations, over 15 currencies. So you can hedge yourself. And that's what's happened to us. When we started investing in Africa 15 years back, we've seen ups and downs, but we've been able to hedge that. And you've seen dislocations in one market, and I see opportunities in Mozambique today. I see opportunities in Kenya, I see opportunities in Senegal I'm able to invest in. And when we do those investments, it transforms and creates economic prosperity. I'll give you an example, like in Cote d'Ivoire, we invested in some road infrastructure there. That's transformed the whole cocoa value chain there. And that improves their productivity, improves the GDP in that country, and also improves labor markets and so many other things. I think that's where most asset managers will be looking at. How do we invest in emerging markets that gives prosperity and also helps in the talent migration issue we're talking about? Because you see quite a number of migrants, complaining about migrants to Europe and US as well today. If we invest in Africa, they'll stay back. Those talents can develop themselves and become the unicorns that we see around. And there can be, this day of technology, you don't need to physically move to get benefits of the services. You can always do that remotely. And that's what we see in Africa. That's why we're investing a lot in Africa as well.
Can I ask you, just in terms of investor perceptions of risk, Africa still sits pretty high on the high-risk list.
True.
How do you improve that perception and switch the narrative?
Okay, 2 things. Risk goes with rewards. Anyway, Africa has the best rewards today. You don't get double digits on invest asset classes in Europe or in America. But then what's happening in Africa is because the geopolitical situation, political situation is changing as well, right? And you have seen a lot more of accountability and responsibility from various governments over the past couple of years across Africa, and that helps. That helps with the credit rating, and with the credit rating, you can invest a lot more. So what Africa really needs is a lot more liquidity, right? And with a lot more liquidity, you're able to build the productive base, and with that productive base, you also build the awareness and the accountability of the people. Because what we have in Africa is a lot of the talents actually moving out. But when you build a social economic policy that helps to bring that awareness, bring access to markets, bring access to basic amenities and so many other things, you'll see a lot more responsible governance. But in terms of risk, right, what we've been able to do is be able to manage that effectively. And when you work with a bank like ours, who've been working across Africa for 7 decades, we know how to manage Africa. We know Africa is what we know, right?
So maybe just to offer a slightly different view on some of this. I think that when we have the privilege of working in Africa, or indeed I think it's actually a great case study for being here in Saudi, one of the biggest issues is the development of a depth of capital markets. Sure. Many of these economies are still very bank dominated, and yet what we need as investors is we need a deep domestic bond market, we need an equity market, we need an IPO market, and wouldn't we love a venture market too? But all of that requires institutionalization of capital. And where do you get that? Insurance companies, you get that from pension plans, and to your point, some African countries have done a great job at building up that, and others not so much. But the opportunity for many developed markets, they've got to deepen these capital markets, which will make it much easier for all of us to move in size.
John, did you want to speak?
Yeah, no, I think on Africa there are two big trends which we can't ignore. One, given that the trade has shifted between China and the United States, it's shifted to China and the global south. I think it's secondly, there's a very compelling story about the opportunities in Africa, not just only because of demographics, but also the role that next generation of technology and artificial intelligence will play in terms of entrepreneurial behavior and capital flows. Totally getting away from the need for bricks and mortar infrastructure, logistics and all that. AI will make a very big difference to the new Africa. Sure. And I think China has figured that out. I think other people are just beginning to figure it out. And I think maybe the next time CNBC should probably host another panel on this particular topic, because I think it would be a great opportunity, particularly to focus on the big economies and how they're going to be transformed by AI.
But at the end of the day, growth is about productivity. And yes, there's a kind of a denominator effect of immigration and other people, but the nature of productivity is fundamentally shifting, not just because of AI, but because more broadly because of technology revolution and because of investments in really soft knowledge, whether or not that's SaaS or other kinds of systems that fundamentally shift the need for labor and the type of labor that it is. And one of the reasons, back to my optimism about the US, is that the U.S. is actually all over the map on productivity, right? That we have a series of technology, driven by technology, but companies and industries that do well, and then I can give you the government, I can give you healthcare, I can give you education, which are just at the bottom of the list. And it's because those places have not really invested in making people more productive. But at the end of the day, that's what's got to drive it. And whether that's here in Saudi or whether it's in Africa, that productivity drive has got to be the goal. Numbers of people won't do it.
It's interesting here in the Gulf, we're also seeing improving sophistication, more liquidity, more depth coming into the capital markets here, and that work continues. I'm just wondering if maybe you wanted to speak to that as well, David. What are you seeing here in the region when it comes to capital market development? Are you encouraged where Saudi Arabia stands so far?
I'm very encouraged. I think one of the reasons you have so many people in such a wonderfully vibrant conference here this week is that people have looked at the last few years and said, boy, there is a real transformation of the economy that's going here. There is political leadership that has been determined to drive this, and there's been capital that's being put behind transformation of industries, and a willingness to invest in domestic economies, not just export capital, but really change the domestic economy in a very effective way. And I think that is extremely exciting, and I think that's why you have such a group of international investors here who not only want to be part of that, but also want to increasingly invest in Saudi in a way that I think you wouldn't have had a decade ago. And I think that's really an exciting and invigorating.
Yeah, and I think David couldn't have been so right. I mean, this is a wonderful event. It's been a great time spending here, and that's why we're also investing here. We're going to set up a subsidiary here soon, next year. You'll see UBA in Saudi. And that will be the second office we have in the Gulf. We have one in Dubai. But Saudi is the right place to invest in, actually. I agree with you.
We only have a few minutes left, and I wanted to shift the focus over to the key risk event that's taking place next week. I know you probably don't want to talk about this, but we are, of course, on the cusp of a really consequential US election. Correct me if I'm wrong, but Harris is kind of seen as a little bit status quo here. Trump's been talking about tariffs and tax cuts that could potentially fan inflation. Of course, the Fed is going to meet 2 days after the US election. So how should you and us as investors be thinking about the market and macro implications here? Sébastien, you can kick us off.
So look, this is going to be a downer of an answer, and I'm sure my co-panelists are going to have more exciting answers. No one knows who's going to win the US election. It is a coin toss. Even if you knew who was going to win the US election, no one really knows what policies are actually going to be implemented, and that depends what happens with Congress, amongst other things. Even if you knew the policies, no one really knows how the market will react. So we're talking about uncertainty. One thing we can perhaps expect is that once we're through this, uncertainty will go down, which is generally good for risk assets. I know it's not an exciting answer. I could make up a story about small caps and Trump, and small caps will rally like they did in 16. I hope that's not what you were going to say. But that's just too simple. It's just not the environment right now.
Katie?
Well, I do have one favorite politician that I want to advocate for here that deserves everyone's vote, which is my mom. She's running for town council in Fairhaven, New Jersey. Local politics is where it's at. Things still do get done at that level. I agree with the comments. It's impossible to predict. Well, I can 100% predict my mom's going to win, but at the national level, it's very tough to predict. And if we did know who it was, it's also tough to say what would happen. I just want to remind people back to 2016, the market didn't think Trump would win. He did. Then he won. The market reacted. It was going to be massively inflationary. He was relatively anti-immigration. He was pro-tariff. And obviously pushed the central bank to be accommodative. But actually inflation, point to point, went down during his administration. I'm not saying this as an advocacy for his candidacy. I'm just saying the world worked out different than everyone thought it would initially. Then once we knew the results, we priced something in that never really ended up happening during that administration. And I think if we are going to get, last comment I want to make, if the US economy does slow down, maybe it will, maybe it won't, it's already been baked. The decisions have already been made. It's not going to matter who's president. They're just going to inherit the recession if it happens.
John?
Regardless of who wins, there's just one loser, and that is the balance sheet of the U.S. Treasury.
Yes.
It's currently at 31 trillion. You can argue one may be more fiscally negligent than the other, but both are going to be likely to be more fiscally negligent than positive. You're dealing with a fiscal deficit now of approximately 6.5%. You have the Trump tax cuts, which either may be continued or repealed.
And by the way, 6 to 7%, we've only done that in recessions before.
Exactly.
We're not.
But it could go over the next 2 or 3, 4 years up as high as 8%. So the loser really is the balance sheet of the United States. And this issue of debt sustainability, it's a real issue, probably more of an issue internationally for international investors looking at the United States than domestic investors or even Washington policymakers. So I would think that is the one thing I'd like to leave the group with in thinking about the US election. The loser is ultimately going to be the fiscal deficit.
Can I ask you, if the US Treasuries are no longer the safe asset, what is?
Ask me that in 10 years.
I was on a panel earlier today, and they said Bitcoin, like it used to be a basket of currencies, maybe. But I just want to emphasize, I think this is the issue. It is an issue. We know that. We are running a 6% current account deficit as a percentage of GDP, and in the US, we've called that an economic miracle. France has the same number, a developed market, and it's a fiscal crisis. So it is going to matter. It's hard to know when.
Yes.
And it is possible that the reason the 10-year the yield's gone up on the 10-year despite the Fed's cutting is that this is the return of the bond vigilantes, and market participants will focus on that in a way that people said they wouldn't. So it is something to watch. I think that's the main issue.
David, weigh in here.
So I think just to conclude here with a bit of a pro tip for the group. Almost all research has shown that trying to take a major political theme from a party and betting against it as an investor is a truly bad idea. And whether or not you take some of the examples that Katie offered, but the difference between a policy ambition, actually getting it through, practically having it, and what we do on the ground structuring investments, that distance is so big as to really make the whole thing nonsensical. I mean, just my favorite example being energy. So Donald Trump gets elected, Bill, baby Bill. Well, if you had invested in oil and gas in 2016, you probably weren't that happy for the next couple of years. You know, Biden gets elected, he talks about the beauty of climate change, the importance of all this. You probably want to sell all of those oil things. Boy, you'd be really sorry you did that. So the exact opposite actually happened on the ground from what you heard. So I would say, I know the media loves to talk about these big themes and others, and it does make good TV. It's a bad idea. Don't try it at home.
I'll leave you with the final thought. Does any of this matter to your business or your investments?
Not at all. The only thing that matters to me is whoever is going to support African growth. That's it. Whoever wins, focus on Africa and see how you can grow that continent. That's my.
All right, we are rapidly out of time, so I want to thank my panel and thank you all for joining in today. We appreciate you watching and watching online as well. Enjoy the rest of the conference. Thank you all.